Hello and welcome to the February 2022 Advanced Projections Economic Report. First looking at January in review, the Federal Reserve and the pandemic continue to exert their respective forces on the economy. The highly transmissible Omicron variant of COVID is spiking its way through the global population 3 months after it was first identified. Infrastructure spending will initially be slow to roll out as state legislatures will still be waiting to decide in early 2022 where they will be spending their apportionments. Inflation and employment figures for January came in at 7.5% annual rate of inflation and a higher than expected new jobs report, up nearly 500,000 jobs. Unemployment is at 4%, at a level that the Fed has fully focused on inflation as they confirm an accelerated pace of their asset purchase tapering plans through early 2022, and interest rate increases scheduled right now for thereafter. Equities have hesitated as less than desirable inflation and pandemic news continues to be made, as well as higher employment news. At the end of this report, we have an historic warning based upon our expectations for an increase in the vigor of Fed upward interest rate moves. Year-over-year consumer price index comparisons and supply chain issues have continued to plague many aspects of the economy, keeping prices and inflation expectations elevated as demands remain above available supplies. CPI figures confirmed the onset of inflation during the second quarter of 2021, and they have continued to rise. January 2022 figures came in at a hot 7.5%. Unemployment's dip over the past several months is maintained at a level of 4%, with new job gains in January of just under 500,000. We expect those gains to continue in a restrained fashion until the Omicron peak has come and gone, perhaps by late March, and then bump up more with warmer weather. We have seen others project that unemployment will reach 3.7% by the end of this year, but our own figures fall into the 3.3 to 3.5% range, keeping labor markets very tight. As we predicted last year, the Fed first announced in November that they would implement a gradual end to asset purchases over the course of the next 8 months, going from $120 billion per month to zero in reduction steps of $15 billion per month. As we also anticipated, the December update from the Federal Open Market Committee described how the Fed was going to accelerate their plan, ending their asset purchases by March instead of June, and that it would be reasonable to expect 3 quarter-point rate increases during the remainder of 2022. With the new January inflation figure in, AP now believes there will actually be 5 or 6 increases, and that the final 1 or 2 may be 50 basis points instead of just 25. That would bring the Fed funds rate up from near zero to about 1.75% by the end of the year. 10-year Treasuries have already begun to reflect more aggressive expectations with a 30-point increase in the first part of this year. Many traditional investors use action in the 10-year Treasuries as harbingers of future equities market revaluations. With the jet-like entry and progression of the Omicron COVID variant a month ago, we were experiencing over 700,000 new cases per day in the USA, up nearly 1,700 daily fatalities. At the time of this report, these two rates have diverged, with fatalities still up near 3,000 per day, but new cases falling nationally well off the peaks from late January. Omicron is not respecting any boundaries as breakthrough infections, albeit mild ones, are occurring among the fully vaccinated as well as the recalcitrant unvaccinated. Hospitalizations, ICU occupations, and fatalities of victims are overwhelmingly from the unvaccinated. We are quickly approaching 950,000 U.S. fatalities, and the horrible milestone of 1 million losses will be breached before spring begins. Fourth quarter corporate earnings reports have been coming in somewhat ahead of expectations with decent year-to-year comparisons against the same quarter in 2020. However, first quarter and annual estimates for 2022 have been tempered substantially. A more complete fourth quarter report and 2022 expectations will be available in our March report. Now, just on February 11th, FactSet tells us this. At this point in time, the number of companies beating earnings per share estimates is above the 5-year average, but the amount by which companies are beating estimates is equal to the 5-year average. As a result, the index is reporting higher earnings for the fourth quarter today relative to the end of last week and relative to the end of the quarter. The index is reporting earnings growth of more than 30% for the fourth straight quarter and earnings growth of more than 45% for the full year. These above average growth rates are due to a combination of higher earnings in 2021 and an easier comparison to weaker earnings in 2020 due to the negative impact of COVID-19 on a number of industries, unquote. So far, looking forward into late 2022, the picture being painted by companies isn't nearly quite so rosy. Earnings increases in 2022 year over year are now being estimated at about 9% with 5% growth in revenues. Companies have now returned to a more normal practice of citing lower expectations in the coming quarters. Now here are the current underlying socioeconomic details. Excuse me. The current employment picture: in January, unemployment levels moved up slightly to a national level of 4%, in spite of a much larger than expected jobs gain of just under 500,000. That combination translates into more job seekers re-entering the jobs market. Recent data estimates show that businesses still have more than 10 million job openings that they want filled. However, a larger than normal number of people have recently retired or otherwise removed themselves from the search for work, and this amplifies a decline in unemployment reflected in the just released 4% figure. The labor force participation rate had declined by 1.7% since February of 2020, just before the pandemic took hold, representing an active labor force decline of 2.7 million, some of which are due to a net balance of retirements and the rest mostly due to the consequences of the pandemic. If the size of the active labor force had stayed constant, the effective unemployment rate would be higher, around 5.25%. In spite of those earlier exits from the labor force, the participation rate had begun to move upward again in the fall. In December, the size of the labor force and the labor force participation rate stayed essentially even with November. Expectations for continuing improvement in employment and the labor force participation rate are still predicted in part or predicated in part on several assumptions, including no new COVID crisis, the national infrastructure package, which will assist by adding at least $120 billion per year, stimulating project-related employment, and on increasing urgent corporate labor requirements to sustain their profit and revenue growth. Just as we had forecast, a downward trend towards and below an unemployment level of 4% would be viewed as a true full employment situation by the Federal Reserve. The prior significant declines below 5% had led it to first announce in November that they would begin a gradual end to their highly accommodative interest rate and money supply policies beginning in mid to late 2022. This was clearly stated in the Federal Open Market Committee statement following their November meeting, where they gave a scripted tapering down of their highly accommodative policies, and then the associated near-zero short-term interest rates beginning now and running through mid to late 2022. Just 6 weeks later, on December 15th, with unemployment heading rapidly down towards the 4% level and inflation heading up to 7%, they modified and accelerated their tapering program, which has been deemed pretty hawkish as an anti-inflation move by many observers. This program is now designed to eliminate asset purchases by March of 2022 instead of mid-year, and then to expect from 6 to 8 Fed funds quarter point rate hikes during 2022 and 2023. With the January high inflation report, those 6 to 8 increases may all come this year in 2022. We now have some good reason to believe that the Fed may begin to increase rates before their mid-March FOMC meeting, and no regular FOMC meeting is scheduled for February, which is quite normal. Briefly about the pandemic, last month we said there are likely to be nearly 50,000 fatalities during January based upon recent increases in cases and fatalities associated with the national and global spread of the new Omicron variant. In the U.S., the Omicron peak is likely to occur in the mid-February to mid-March timeframe and take several more weeks to wind down. Well, all this has come to pass. By early February, total U.S. COVID fatalities reached over 910,000, up approximately 60,000 just in the past month. We are inexorably moving towards the 1 million mark as fatality rates during this past week have hovered around 3,000 per day. We expect them to decline below 2,000 per day by the end of February, but that is hardly something to celebrate. Our expectation for the end of the pandemic, barring any new super variants, is that for that fatality rate to fall below 400 per day and stay there. Still quite a horrific number, but within the ability of our social fabric to tolerate while new and more effective treatments or preventatives come into being. Now we're skipping over a bunch of material in the audio report, which you can read in our written report, which provides much more detail on COVID and the validation of our fatality model that we've been using for a year and a half. Now, regarding equities, in January, equities markets managed to try again to push at the recent record levels, but failed. Speculators were completely ignoring the accelerated Federal Reserve plans to slow the growth of the money supply and increase interest rates by buying the dips, but smart money was taking money off the table every time there was a rally. Markets held on to near record pricing through the end of the month. The first part of February has been a different story, however. S&P 500 earnings for fourth quarter 21 have come in so far at this time are showing about 30% revenue growth for the fourth quarter. Basically, 30% revenue growth over the fourth quarter of 2020, which was recorded during the depths of the first COVID winter surge. With increased energy prices and interest rates on the horizon, energy companies and banks should continue strong in the quarters ahead. For the balance of companies yet to report, there are similar year-over-year growth expectations for the fourth quarter due to comparisons against a depressed fourth quarter 2020. However, the market should be looking 6 to 12 months ahead, and the estimates for S&P earnings and revenue growth are far less aggressive, in the vicinity of 5% revenue growth and 9% earnings growth. Here is a chart which we include in our written report courtesy of FactSet, which puts the 2020 through 2022 earnings growth picture in perspective. These estimates may yet be revised downward as the Fed applies the brakes to the economy in the coming months. Now, there may be more upbeat surprises that could show up later in the second half of 2022, but businesses still face many uphill challenges from supply chain constraints, higher energy prices that continue to move up, as well as ongoing labor shortages. Now, add to that is the higher cost of capital that will start climbing. In the past year, the markets have only taken one short-lived break along the way to nosebleed territory from the lows set in 2020. But a return from the current bubble territory to warm market levels would take the S&P down to about 3,500, which is 1,000 points below where it's at right now, and a correction to the mean would be near 2,800. We are still due for such a correction, but something will need to trigger it. At first, the Fed's recent rescripting of their programs seemed to only make the markets more confident and that it was likely something else would have to come along to rattle the confidence of market speculators. So the S&P 500 briefly penetrated the 4,800 level near the end of 2021. January saw this index trim off about 6%, and so far in February it is down another 2%. The high-flying growth stock NASDAQ is down almost 13% in the same 6-week time period, officially entering correction territory. Further price action depends on a whole host of interacting phenomenon, but historically speaking, as rates rise, stocks will eventually and generally move in the opposite direction. If the Fed sees fit to announce a rate hike, potentially up to 0.5% before their March meeting, this could wake up a greater portion of profit takers than we have seen so far. The trick is to not be the last one out of the pool as the large and inevitable correction takes place. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets. Heavy margin borrowing that is synchronized with markets making significant new highs is a likely strong leading symptom for a market correction. In December, margin borrowing dropped back a bit less than 1% and down less than 3% from October's all-time high. So this level remains very, very high. And then we include the graphic in our written report that's courtesy of Advisor Perspectives. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.